Hi, it's Chris Lipper from On the Bus Sales Training, Coaching, and Consulting, and this is our October Lunch and Learn, where we have Jen Peel from M&T Bank presenting. And one of the things I'm very proud of with On the Bus is some of the relationships we have. And we've developed a very nice relationship with M&T Bank, and their focus are our members, and our members are doing well at M&T Bank, and it seems to be a nice fit. And I hope we continue this series. This is the second in the series of some financial literacy that Jen is taking us through. And I'm guessing we're going to start with perhaps some PPP loan forgiveness updates or things like that, but I don't know that for sure. I'm going to hand it over to Jen and let you do your thing. So thank you very much, Jen.
Thanks, Chris. Hi, everybody. My name is Jen Peel, and I am with M&T Bank. I'm the branch manager in the Parsippany branch, and we're located at 240 Baldwin Road. Most of my job includes helping businesses and business owners with their financial struggles and needs. And since the pandemic began, M&T is looking at a more holistic approach to business banking. So relationships used to start with lending, just because that was kind of where we would see the need and be able to fill it. But now we actually prefer to start with deposits. This way we can understand how money moves in and out of a business, and then we can better support or explain the need for lending when it arises down the line. During the PPP process, M&T played a big role, and we were able to secure SBA approval for 100% of the completed applications for eligible businesses, which is a pretty impressive statistic. We did this by pulling in 2,000 employees to work on the PPP process. This is in the earlier initial application process. And because of that, we ended up helping almost 33,000 businesses. We dispersed nearly $7 billion in funding, and the businesses that we helped employed over 718,000 people. So that's how many lives that we touched. And specifically here in New Jersey, there were 789 companies that employed over 23,000 people that we helped just here in New Jersey. So we're now in the PPP forgiveness phase. So last time I spoke, I went into in depth in the process of the forgiveness application. So now we're in the process of having the applications being worked on, so that we're rolling it out kind of gradually, and it's based on how you applied. So not even everybody who got the funding is even able to apply for the forgiveness yet. We're kind of rolling it out gradually just to make sure we're able to, manage all the ones that come in and get them completed. So that's the stage that we're at right now. So, if you're a business and you went ahead and you got your PPP lending and, you're going to get your forgiveness, but now you've kind of found that your business has pivoted and maybe you need to make some other changes. What happens next? Like, what do you do now? Maybe you need a business loan. So what I want to talk about today is business lending, kind of how we approach it, what needs to happen. And the thing I'm going to spend the most amount of time on is actually credit scoring and credit reports, because your personal credit score is the biggest factor in business lending. So I want to spend some time explaining how your credit scores are kind of arrived at, what you can do to maybe bring them up, how you can check on the reporting. So that's going to be the bulk of what we're going to talk about, and it helps you in your business, but it also helps you in your personal life. So it's something that everybody should be able to relate to, and hopefully it'll be helpful. So my personal focus with M&T Bank as a branch manager, I like to work with businesses that are under about $2 million in annual revenue. I can definitely work with businesses bigger than this, but I feel like the smaller businesses are the ones that are kind of underserved in a lot of things. So that's sort of my sweet spot and where I like to help people. So it is best these days to start off with deposit accounts. So if you're looking for business lending kind of down the road, this is sort of the process you should kind of keep in mind. You want to start by establishing your checking account. Maybe along the same lines or at the same time, you can also apply for a business credit card. Then after a few months, after you have a little bit of history with your financial institution, the time would probably be right for, either a loan or a line of credit if that's what your business needs. So the difference between a loan and a line of credit, a loan you would take for a specific purpose. It's usually a fixed term, probably a fixed rate, and it usually is for like an item. So you would think of either a piece of equipment or maybe a vehicle. So if that's what you want to purchase, you'd probably want a business loan. So as opposed to a line of credit, which usually lines of credit are based on, you'd want to size it based on your annual sales. So if, for example, your annual sales are $1 million a year, a proper size line of credit would be about $100,000. You want to take 10 to maybe 15% of whatever your annual revenue is. That would be a proper size of a line of credit for your business. And a line of credit, it's for short-term lending, so it wouldn't be for something that would depreciate like equipment or a vehicle. That's the loan. But you'd borrow it with the intent to pay it back quickly. So people use it maybe if you're doing like a project-based, something that's project-based, and you just need, a little bit of money to either purchase materials or, maybe to purchase a service for the short term, and, then you'd pay it back. You also, a lot of companies use it to cover payroll. Either they're going to hire somebody new, or, they haven't gotten their money in, but they need to pay their people, so they borrow off their line of credit to make their payroll, and then when they get paid, then they can pay it back. So that's the difference between the two. So there's a number of things that affect business lending, and I'll kind of go through them because, well, the biggest one is the credit score, but I'll go through the other ones first. So one is the time in business. So the number of years that you've been in your business is a big factor. Another is the owner's expertise or knowledge. So you may be only in business for 2 years doing whatever you do, but maybe you've been in that industry for 20 years. So that's gonna be a factor. That's a good thing. Sometimes the industry itself, there's strength in certain industries. For example, somebody who's like an attorney or maybe a CPA, they've gone through years of schooling, they've invested a lot in themselves. That industry is probably going to be stronger. And maybe even like a landscaper or trades, those businesses are strong because, or industries are strong because people need that service. People need that industry, as opposed to maybe something like a candy store, which, that's more of a need or a want than a need. So that could be something that, in a bad economy, people might not go to the candy store because they can't afford it, or it's just not something they need. So, so the industry itself does have some, different levels of strength. Sometimes collateral matters. We lend mostly on cash flow, so we want to make sure you can pay back a loan and your cash flow is strong, and we'll look at that. But collateral does kind of play into it a little bit. We want to make sure if for some reason something goes wrong, there's something that, that backs you that we would have access to. Just makes you stronger. But like I said, the guarantor's credit score is really the most important factor. So that's what I'm going to talk about now. But before I do that, does anybody have any questions before we jump in and kind of focus on that?
I have one. Just years of business. Is there a minimum that you guys have like a cutoff on?
Not necessarily, but usually if it's less than 2 years, the deal could go SBA, which just means that the bank kind of shares the risk with the SBA. It just makes it more viable for us to be able to do it. It's a little bit more paperwork on your part. Maybe it's a little higher rate, but usually if it's under 2 years, it's more likely to go SBA. Over 2 years, it's more likely to be conventional.
Okay, thank you.
Mm-hmm.
Can you talk more about the cash flow situation that you brought up? So what if somebody has bad credit, but you can see their cash flows increased?
Well, it all plays a part. it depends. I mean, the cash flow helps. I mean, if the bad credit is the only thing, and it might depend on how bad it is, you know, if it's bad credit and you've had bankruptcies and delinquencies, it's probably not gonna go through, or you probably need to repair it, which is one of the things we're gonna talk about.
Okay, so then you'll answer that as we go along. Any other questions?
Yeah, I think Paul had one.
So with the, you do asset-based lending? You said
Yeah.
you'll look at that. So will you do like a percentage of the assets?
Yeah, and I mean, they'll look at everything. And I mean, obviously, that it's not like M&T is a cash flow lender. Like, we're not really a collateral lender. We're not in the business of going to, you know, get at somebody's house and resell their house to get their money back, or, you know, go after their 401ks or their, you know, retirements or their investments.
Inventory? Will you look at,
Yeah,
like,
I mean,
inventory?
it helps make them a stronger guarantor, but like I said, they're not, like, I had a company that they sold light bulbs. So, you know, they had lots of, you know, money invested in all their products and in warehouses all over the place because he sold it at Amazon, through Amazon. But obviously, like, it would be a lot of work for us to go and, like,
You want to be in the light bulb business.
Exactly. Exactly. So it helped his strength as a guarantor because it did, you know, he had something behind him, but it's not, we really were looking at the cash flow to make sure that that made sense. Then the collateral just kind of supports it a little bit.
Do you have to get personal guarantees from the
owners?
Yeah.
Yeah, depending on how the ownership structure is and the percentages and how many, but yeah, if it's like a simple, you know, one owner, 100%, there's definitely gonna be a personal guarantee.
So what if somebody was in the blacktop business and they needed a new dump truck, let's say? So that's something that you could repossess. Would that be more attractive than others?
Yes. Yeah, because you'd have because the piece of equipment, the dump truck, would be the collateral.
But if it was a crane, maybe not. So I'm just thinking, so if it's something you can unload easily, I guess.
Well, I mean, yes and no. I mean, it's still collateral. Like, it's still the piece of equipment, and it still has value. So it may or may not make or break a deal, but it definitely makes the borrower stronger.
Okay. So it's better than if they were paying for a service, let's say legal fees or whatever it might be.
Right. Yeah, because like an accountant, like, they don't really have collateral. Like, they don't, a lot of times they lease their space. They don't even have a building, you know, that they own. But again, their industry is strong because they've put themselves through schooling. You know, they're not as likely to, you know, if you spend all the money and you go through school and you become an accountant, you're a lot less likely to change jobs somewhere down the line because you've already invested a lot. Not to say that it doesn't happen, but those are the reasons those service industries are stronger, just because of, you know, the time and the money that people invest in themselves to put them where they are. So, and those industries are not going to go, you know, they may be less used at some points in time, but they're never going to go away. People are always going to need them.
Right, as opposed to the candies where you referenced before.
Right. Those are extras that, you know, you may or may not, you know, you don't need.
A year ago, a mask industry came to, or a plexiglass company, and now all of a sudden, look at them, you know, so I guess that can
True.
Too. But,
True. Yeah.
Any
all right, so I'm going
to out there? We're good? All right, let's keep going.
All right, so I'm going to share my screen, and we're going to talk a lot about credit scores. So let me just make it the full screen. Okay, you guys can see that okay?
Yep.
Okay. All right, so let's go down. So your credit can have a big effect on your financial life. Your credit report provides a snapshot of your financial habits that financial institutions, cell phone companies, credit card companies, and others use to get a sense of your credit worthiness. Understanding how credit scores and reports work will help you get your finances healthy and help you achieve your financial goals, such as buying a home or a piece of equipment, leasing a car or a vehicle for your business, paying off debt, getting a line of credit, et cetera, et cetera. So just to understand how much you guys understand about credit scores and credit reports, I think I can see most of you. You can either raise your hand or you can unmute yourself and just let me know how you answer these questions. So anybody ever checked your credit score? Hopefully everybody kind of knows what their credit score is. Have you ever requested a copy of your credit report? Okay, good. How about used a credit card? And everybody have experience with taking out a loan? Okay. All right, so before we get really into why credit scores are important, we'll discuss what they actually are. So credit score is a 3-digit rating that tells a lender how likely you are to repay debt, and different lenders use different criteria to calculate it. So poor credit is less than 600. So people with a score of 600 or below could probably use help or rebuild their credit history. So fair credit is between 580 and 670. In this range, it may be difficult to qualify for loans, and if you do get a loan, it may have a high interest rate. So good credit is between 660 and 740. So if your credit's between 660 and 740, you may have blemishes on your credit report. You may be restricted to higher than average interest rates on loans. So very good credit is between 740 and 799. So at this rate, you would qualify for most loans. You probably have a solid credit history with maybe a few missed or late payments, or your credit history might just be shorter. So exceptional credit is between 800 and 850. So if you're above 800, you have the strongest credit history, you qualify for the best loan terms and the best interest rates. So these ratings are for informational purposes later. Later we'll get into how they're actually calculated. So your score can be poor, fair, good, very good, or exceptional. But what if you don't have any credit history at all? So it sounds like most of you guys all do, but you could come across clients that are in these situations. So just kind of good to know how you can maybe help them if you would need to at some point. So many people, especially young people or people who have recently immigrated to this country, they have no credit history. It's not a bad thing, and it's not the same as having bad or poor credit. It's just that they will face some difficulties in getting loans or proving their creditworthiness because they don't have the history. But there are many steps on what they can do to start building credit. So step one is open a line of credit. So this could be a credit card through a bank or a retail store, or a small loan that you can repay on time and in full. Special products such as secured credit cards and credit builder loans are designed to help boost your credit, but they may have restrictions on how much money you can borrow or may require you to put down cash collateral. So if you've recently immigrated to the U.S., you'd need proof of address and some form of government-issued ID, such as a passport or foreign ID. So step two, request that your payment history be reported. If you pay your rent and utilities on time, you can request that your landlord or utility company report your positive payment history to the credit bureaus. However, remember that your landlord or utility company isn't required to do so even if you ask. So step three, you can open a joint account. You may request a family member or friend with good credit to co-sign a loan or a credit application, but remember that your actions will also affect their credit. So make sure joint accounts are reported to the credit bureaus. And then step four, pay all your bills on time and in full. Never miss a payment. If you think you're about to miss a payment, contact a creditor, see if options are available. So how does your credit score affect your daily life and ability to achieve your financial goals? So we'll take a quick look at this scenario. We don't need to spend a lot of time on it, but just for illustration, we'll meet Anna and Bella. So Anna and Bella have been friends since middle school. They both own cars, and they both have steady incomes to pay their bills. Anna's credit score is 530, and Bella's is 700. Anna and Bella decide to buy homes in their childhood neighborhood. One of them receives a loan without any trouble, and unfortunately, the other has a difficult time getting a loan. She finally gets her loan approved. Her interest rate and insurance premiums are higher than her friends. So I'm sure you can see where this is going and you know what the benefit is of having the higher score. So Bella has the higher score. Bella's going to be the one that has an easier time. So this is the effect of credit and poor, bad credit versus good credit. So credit scores are not the only factor that lenders consider. Other factors such as the market, down payment amounts, loan terms, lender loan policies can influence the cost of a loan, but experts and research show that one's credit score has a large effect on the cost of a loan. So as you've seen, credit scores can affect your ability to get a loan, as well as your interest rates and your insurance rates. But they can also affect your eligibility for a rental home or leasing equipment, things like that, because all of that also goes through, most of the time, credit checks, and it can even affect you possibly getting a job. So essentially keep in mind that any persons or any organizations that you belong to, businesses that you work with, and even B2B kind of stuff, they could seek information, credit information, to review your credit report before they want to do business with you. So just keep that in mind, both on a personal level and on a business level. So who actually comes up with the credit scoring system? So I'm sure you guys can, the name of the credit scoring companies. There are three main agencies. Well, there's a lot of agencies, but there's really three main ones, and they use popular scoring models such as FICO and VantageScore. So the three main credit bureaus in the U.S. are Experian, Equifax, and TransUnion. They, along with lenders, use their own version of the FICO or VantageScore credit scoring models. The bureaus keep track of your credit history separately, so it's a good idea to utilize each one. If there are large variations or discrepancies among the reports, you should get in touch with the bureaus to figure out why. Credit scores may also be different depending on the financial product you're applying for. For example, mortgage applications may yield a different score for you than if you're applying for a credit card. So how are scores calculated? So as mentioned earlier, different credit bureaus calculate your credit score in different ways. While the bureaus do not disclose the exact methods or formulas they use to calculate your score, we do know the general factors that they consider. And the most important factors that affect your credit score are your payment history and the amount of debt you owe. So let's take a closer look at these factors. So the payment history. This primarily includes looking at whether or not you pay your bills on time. Do you always pay at least the minimum amount? If you do, then you're in good shape. If you make even one late payment, though, it will likely have a negative impact. That's why it's so important that you always pay your bills on time and pay at least the minimum amount when you do. So amounts owed. So the amount you owe depends on two major factors: how much you actually owe on your credit card or loans. So owing money doesn't necessarily mean you're a risk to lenders. The most important thing is showing that you make regular on-time payments towards your debts. By the way, if you're an authorized user on a credit card or have authorized someone else on your own credit card, their payment history will affect both individuals, so the card owners and the authorized users. So we'll talk more about sharing credit in a little bit. So the other factor here is what percentage of your available credit you're using. So typically people who are using less than 30% of their total available credit, they'd present themselves as a lower risk to a lender than people who are using 90% of their available credit. So simply put, if you have your credit card maxed out all the time, that could definitely negatively impact your credit score. So the next kind of biggest impact is the length of credit history. So credit history is how long you've been managing your credit. So the longer your credit history, the more information a lender has about your repayment habits and reliability. So people with a short credit history, even if it's steady and good, might be at a disadvantage just because they're considered to be higher risk because they just don't have the data to support. So it is important to build and maintain good credit early. So new credit. So if you recently apply for accounts, this will also impact your score. So every time you apply for new credit, a lender runs a credit check on your, or a check on your credit score. It temporarily decreases your score, probably only for 30 to 45 days. So it's pretty quick, but you want to just make sure you're not doing it too many times in a short amount of time, because it could signal that you're using too much of your available credit. So you want to just be cautious of that. But keep in mind too, something like applying for a mortgage, it's probably not going to impact you that greatly because that's a long-term thing. So it's more of like credit cards. You don't want to open a ton of credit cards right in a row. And then different types of credit. So this is a really kind of the smallest portion, but if you have a mix of different credit cards, different types of loans, you know, maybe a car loan and a mortgage, that could affect your score. Then, you know, if you only had credit card loans, or credit card bills, but that's the smallest percentage. And if you're managing it, it probably actually helps you in the long run. So obviously, the way that's calculated is pretty complex. There's a lot of you know, things that go into it, but there's a lot of things here that are within your control. And that's the part that I wanted to make sure, because even in the business lending, this is the thing that you kind of have more control over. Like, you know, the length of time in business, it is what it is. The strength of the industry, it is what it is. You can manipulate and control your credit score, and this will, you know, be a bigger factor in getting business lending. So in terms of co-signing, we'll talk about like how this affects your credit score. So many people think co-signing on a loan is a helpful action to take, especially, you know, if you do it for your child or a significant other, maybe even a parent or a close friend. And obviously, a lot of times married couples or people in long-term relationships decide to merge their finances. And just want to make sure you guys know and understand how this decision could affect your credit score, because, and ultimately it could affect your ability to get business lending or not. So it may not sound totally important and relevant, but it is. So has anybody ever co-signed on a loan for somebody else? Okay. Or maybe even just a joint credit application or a joint checking account added as an authorized user. So, and a lot of these things are totally fine. You just need to make sure you're aware and transparent in both their situation and your own situation, because you don't want them to negatively impact you or you to maybe negatively impact them. So we'll go through just a couple quick scenarios. All right. So Anna's house is in foreclosure. She wants to try to, you know, have somebody co-sign. So should Bella co-sign? You know, that's going to affect, you know, Bella's credit score. So, you know, just presenting the scenario and just for food for thought. This is probably not a great idea on Bella's part, but, you know, because it may impact her credit score, and it definitely the loan would appear on her credit report. So, you know, just be cautious in these situations.
And can I interrupt for 1 second on the?
Yeah.
Yep. Length of credit pertaining to
History.
cards. Yeah, history. Yep. I have a few, some for business, some for home, mostly for miles. So that works out. But I think the lowest one I have is 4 years. If I drop that one off, does that then help the credit score go up? if I canceled that card?
It depends, because when you cancel a card, you're also eliminating some of your available credit. So if you say you have a $10,000, limit on that, and you really only use a couple $100, so you have a lot of available credit or a lot of credit available, and then you cancel it, you're just canceling some of your available credit, which brings your percentage,
Yeah. Okay.
Negatively impacts it. So as long as you're making your payments on time, it's not a bad thing to have them, and just like when you open a lot of accounts quickly, like in a short amount of time, if you close a lot quickly, like that also could negatively impact it. So, I mean, if it's truly really something you don't need and you don't use, then, it's probably fine to get rid of it, and it'll, the scores will work itself out. It might be like a negative impact, but it's going to be one of those short term, 30 to 45 days, maybe you'll have a dip and then it'll come back up again. So you probably have to look at it on a specific situation to see, what value it really has in the grand scheme of things. But it might be okay to close it too.
Thank you.
On that
Sure.
line, you want to make sure that you leave, that you're utilizing 30% of your open credit lines, that you don't squash your credit lines down to the point where you're up to like 80%.
Exactly.
Yeah. Yep. Big picture. I
Yeah.
get it. Thank you.
Yep. All right. So now on this slide we have Michael and Tamika are getting married in 2 weeks, and they're thinking about merging their finances by opening a joint checking account and applying for a joint credit card. So Tamika has a good credit score, but Michael does not. So should they sign up for joint credit?
Oh.
So probably correct. So many couples choose to get joint accounts because it's convenient. But it's important to remember that even if couples if a couple merges their finances, they'll still have their own individual credit scores. It's not a joint credit score. So that's good. However, if they go to purchase a home where both their credit scores are going to be run, they may end up receiving a higher interest rate because Michael doesn't have good credit. So it could actually negatively impact Tamika, because if they go to make a joint purchase, it's gonna hurt her. So in some cases they don't look at both scores. Maybe they'll just look at the highest score, but sometimes they'll look at the lowest score, and oftentimes they look at both. So just something to kind of be aware of and pay attention to. So applying for credit on your own or with someone else can affect your credit score. So be mindful of your own credit score before making decisions to co-sign a loan or merge accounts with someone else. Their actions, like not paying back a loan or missing a payment, can damage your credit, and their credit score can affect the cost of financial products for both of you. So adding an authorized user to a credit card is also a common way to share credit, but keep in mind that the primary cardholder is responsible for paying the bills. So if you both use the card responsibly, it can increase both of your credit scores. So it definitely could be a good thing. You just need to be mindful of the overall picture and don't take unnecessary risks. If you don't have a good feeling, then don't do it. All right, so we'll talk a little bit about credit reports. So some of you guys have pulled your credit reports before, which is great. And your credit report is basically a snapshot of your credit profile, including all your history. So every time you take out a personal loan or apply for a credit card, even store credit cards, all these actions are going to appear on your credit report. So it's important to review your credit report regularly. It's one of the tools to build and maintain good credit. So the 3 nationwide credit reporting bureaus calculate your credit score based on the factors that affect it. many people wrongly assume that checking their credit score or report will affect it negatively, and that's not true. So keeping an eye on your credit report actually can help you like positively, because if there's any fraud or anything on your account, you're more likely to see it, detect it, and then be able to maintain or work towards like keeping a better credit score. So you get one free credit report from each of the 3 credit bureaus each year, and you can get it online or by phone, and the number and the website are up there on the screen. And what we kind of recommend, and by the way, this is the only website that's federally authorized to give your credit report for free. So make sure this is what you use when you do it. And you do get one per company free each year. So what we kind of recommend is maybe requesting it every 4 months. So get your Experian, and then 4 months later get it from Equifax and get it from TransUnion. That way you can kind of monitor it, you know, multiple times throughout the year, and see if there's any. They're not going to match exactly, but you'll be able to see if there's a big discrepancy that you don't recognize, or somebody's applied for credit in your name and it wasn't you. So spacing them out will be better to be able for you to monitor it. So there are other instances where you can get additional reports throughout the year besides one. So you are entitled to one extra free report if certain things happen, which are all bad things. So if there's any fraud, so if you are able to identify fraud on a credit card or something like that, or if you have identity theft, you would be eligible to receive an additional free report. If you've been denied a loan or credit or insurance or employment, and that was based on your credit report, you're eligible for, to see that report. Even if you've done it, once already, this is another way to get it an additional time. If you're unemployed, but you plan to look for work within 60 days, you're eligible for another credit report just to check your status. And also, if you find that you're on welfare, you're also eligible for additional reports. So your credit score, do you guys know if your credit score is included on the report?
Yeah.
Okay. So you can request your credit score from the 3 bureaus, but they do charge a fee. So it's not part of the free report, but you can get it. Does that make sense?
Yeah. What about
Okay.
like Credit Karma and all that? They just shoot out your info.
Yeah. So if you're monitoring your credit, like your credit score, Credit Karma is a fine way to do it. Or a lot of times if you have a credit card, like they now include it with, your statement. Just keep in mind that when you need to actually apply for credit and one of these bureaus runs your credit, your Credit Karma score is probably inflated. So, and it could be by like 30 to 40 points.
Yeah.
So if you have if you have an 830 according to Credit Karma, you're still going to have good credit, because even if they're inflating it by 40 points, you still have a 790, which is still good credit. So, but if you're thinking that you want to apply for a loan and Credit Karma is telling you you're at 650, like you might really be at 610. So you might be. So just keep that in mind, that those numbers are inflated. But what's good about Credit Karma is if you're 830, and all of a sudden 1 month you're down to 780, like something happened. So if you're monitoring it and there's a dip, you should find out why there's a dip.
Now, if you,
Chris, sorry.
I have one more. Sorry, Chris.
Okay.
There's a lot of, I don't know if it's wisdom or advice, but to freeze your credit until you need to, apply for something.
It's not a bad idea. It's not a bad idea, because then anybody who is fraudulently comes across your information. So it's kind of a pain, but we run into it a lot. If somebody applies for a loan, our underwriters just reach back out to us and say, let them, the business owner or the person has to unfreeze their credit and they just call the credit bureau, they unfreeze their credit for 24 hours, and at that time we go in and we pull their credit and their reports and stuff, and then it gets frozen again. So it allows that, it gives them protection. So it's not a bad idea.
Thank you.
Good question.
Quick question. I've got somebody at my door, so I got to jump for a second. But if
Okay.
you're compulsive about checking your credit, does that affect your credit? Like, does it affect your credit to check your credit?
Like your credit score or
Yeah.
your report?
Your credit score?
No, like if you go to Credit Karma 10 times a day, that's not going to affect it.
Okay.
No.
All right.
No.
Talk amongst yourselves. We'll be right back.
Okay. All right. So, so credit scores, unlike your credit history, they're not included in the free credit reports, but you can get them, for a fee. So once you've requested and received your free credit report, how do you make sense of it? So your credit report will contain 4 major sections. So you want to review each section for accuracy, make a note of anything that's inaccurate or unknown or suspicious, and then in a little bit I could show you what to do to dispute or get them corrected. So the 4 major sections of the credit report are your personal information, the public records section, credit accounts, which lists your open and closed accounts, and then credit inquiries. So some information that won't be included is any medical information, any information about religion, race, or sex, any information about your checking or savings accounts is not included, any debit cards or prepaid cards are not included, and any private loans that you've gotten from either benefactors, family, friends, those are not included. So requesting and reviewing the information on your credit report is the first step towards maintaining and building healthy credit. So we'll go over a couple of things that you want to look for when you're looking at your report. So it's important to review your credit report regularly, as we've said. Your credit report contains information about your credit history and how well you manage debt. So it can also be affected by public records such as bankruptcies, unpaid debts or bills, or how much of your available credit you're using. Most of these types of information can remain on your credit report for up to 7 years. Bankruptcies can remain on your credit report for up to 10 years, and certain tax liens can remain on your credit report indefinitely if not paid off. So look at these important dates carefully and make sure that you pay attention to these when you're looking at your report, and make sure that they're accurate. The date that your account was opened, any dates of delinquency, dates of public record, dates of credit requests. So just make sure everything on here makes sense. And then as far as the public records, so any public records of legal activities should be erased from your credit score after 7 years. So if you have something on there that's over 7 years old, that's something you can inquire about. And keep in mind, it's 10 years for bankruptcies. So it'll appear on your credit report. It doesn't necessarily mean it's a factor on, the decisioning of a loan or not, but it'll at least appear on your credit report. So just keep that in mind. So if you notice any errors, you have to dispute them with the credit bureaus. So you can also choose to work with a credit repair company, but you have to be very careful about that because there's a lot of fraud when it comes to that, and you have to know what your rights are as far as that goes. So reviewing your credit reports thoroughly is a good practice, and if you come across information that's incorrect or fraudulent, you can take action. So the first step is knowing what your rights are. So credit repair companies will offer to fix your credit for a fee. So knowing that the Credit Repair Organization Act prevents credit repair organizations from engaging in deceptive practices such as false advertising that can harm you. It requires these organizations to be transparent about what they can do for you. In other words, credit repair organizations may not overpromise, for example, to delete all bad credit, irrespective of whether it's legitimate debt that you have accrued or not. Also, credit repair services cannot demand advanced payment. They must put contracts in writing, and they must offer consumers contract cancellation rights. So your rights as a consumer are protected, but what can you do if you have bad credit? So you want to repair your credit. So you have to take a look at everything. You have to take a hard look at your finances, your bills, your spending habits, any unpaid debt, tax lien, and judgments that can definitely negatively affect your credit score. And if that has happened, what can you do once it's been damaged? So the good thing is that you can start today. You can always start and get on track to repair your credit. So contacting the credit reporting bureaus and informing them of any errors or false entries is definitely what you want to do first. So if you find something wrong, make sure you report it. So when you go back to the reporting bureaus, make sure you include your credit report, list anything that you're disputing, state your reasons for disputing them, include copies, not the originals, of any documentation that you need to support your request for correction, mail it via certified mail, and request return receipt. The credit reporting bureaus are obligated to respond to you, usually within 30 days. However, if they decide that your dispute is based on unfounded claims, they may not do so. So make sure you include all the supporting documentation for your request from the start. So step 2, at the same time, you need to contact the company that provided the information to the credit reporting bureaus and inform it of any errors. The company could be a credit card company, a financial institution, an employer that denied you service based on information on your credit report. So include the same information, your credit report, a list of the disputed items, a clear statement of your reasons, include copies of the documentation, and also mail it via certified mail and request a return receipt. So preventing fraud and fixing incorrect information are important reasons for reviewing and checking your credit report regularly. But what happens if you have experienced an unexpected life event, such as a bankruptcy or a divorce? So if you've been through bankruptcy, foreclosure, or divorce, there are steps you can take to reestablish your credit. They're very similar in establishing initial credit. So step 1, monitor your credit reports and your scores. Step 2, pay your bills on time and regularly. Nothing builds credit faster than regular and consistent payments. Step 3, get credit counseling. So not-for-profit agencies advise people about money and debt management. They help them create financial plans, and they offer workshops. Step 4, consider financial products. As discussed, getting a secured loan or a secured credit card can build your credit. However, they may be trade-offs such as fees or minimum deposit amounts that you should understand and ask the financial institution about before applying. All right, I know we're getting close on time here, so I just want to kind of go over some potential scams that you may come across in repairing. There's a lot of people who want to totally scam you in repairing your credit because everybody wants to repair it quick. So in this little blurb in the middle, the first company, they promise to remove Anna's bad credit from her report. She just has to pay an upfront fee. She's worried about her bad debts, but the company assures her that it can scrub all negative information from her report. They also tell her not to contact the credit bureaus directly, since doing so will negatively affect the company's efforts. So there are lots of red flags here, and I think if I just skip to the next slide, it just gives you basically you only pay for the repairs. Like if they fix it, you pay after, not upfront. They're not going to scrub all negative information. If there's something on your credit report that's legitimate, that there's a reason you have negative, a negative mark, like they can't take that away. Like that's legitimate. So if they promise to get rid of all of it, like they can't really do that. And if they tell you not to report or contact the credit bureaus, also a red flag. So other signs of a credit repair scam: don't ever sign anything on blank paperwork. If they say they're going to change your social security number, all of that stuff is a scam. We'll want to consider taking advantage of credit counseling services. Many of these agencies offer a free initial session, and these agencies may help you create a financial plan that decreases your debts and then gets you kind of back on track. So if you choose to use credit counseling agencies, look for agencies accredited with either the National Foundation for Credit Counseling or the Financial Coaching Association of America. And then get information about their services and any possible fees, before you pay anything, obviously. So here's kind of a quick summary of what you want to kind of keep in mind. You want to keep using or use less than 30% of your available credit. Don't max out your cards. Pay your bills on time. Pay off your credit card bills each month in full if you can. Pay your loans on time. Don't apply for multiple loans and credit cards at the same time or within the same time frame. Make a financial plan to reduce your debt, follow a monthly budget, and then review your credit report. And then there's the total summary. So the moral of the story, there's a lot to it. I think some of you guys are pretty familiar with some of the strategies, but there's always little tips and tricks to sort of learn. I think the annualcreditreport.com is something that I know I could personally do a better job at. I just had a neighbor who, it's just a neighbor, like a guy who got a bill in the mail from the SBA for a disaster loan that somebody got his social security number and got $10,000 in his name. He doesn't even own a business. So it clearly wasn't him. So I had to coach him on, he froze his account, or he froze his credit score. He reported it. He, went to all 3 credit bureaus, but total headache on his part. But somebody stole a social security number somewhere along the way and applied for it. And he was able to straighten it all out, but total headache for a couple of days and a lot of work and a lot of frustration. So that's the benefit of kind of monitoring the credit report. So any questions? Chris, Lipper.
A lot of people around me do very well with accountability. And I don't know, do you offer any kind of, let's say, monthly coaching or coaching where you can, set up somebody with something to do monthly, they come back and check, and you see how it's going then, something like that? I don't know if that makes sense.
Not anything formal, but I know this is kind of like the full-blown presentation. We have, like, M&T actually has some little, like on our app, like little presentations on that kind of break down a lot of this, but in smaller kind of segments. And then we also have, as part of our app, it gives you like a budget, or gives you like a pie graph of like how you spend your money, and you can kind of look at it. Like it's personal, so it's probably hard to compare or put people in a group together to really talk about it. It's, it's a sensitive topic. But in terms of like the accountability piece, there's certainly ways that you could kind of keep yourself accountable. I mean, I'll work with you if you want to. I wouldn't probably recommend it in a group setting necessarily, just because it could be.
That's exactly what I meant. And not necessarily for me, but I might take you up on that. But a lot of people do well having coaches in their lives. And this is an area where coaching could probably help. And a lot of coaching is just accountability.
Mm-hmm.
So
definitely.
Okay, good to know. Any other questions out there? I can't see. Are we done with the screen share view?
Yeah, I can stop sharing.
Okay.
I hope that was helpful and not like too much info. I know I ran through a lot of stuff pretty quickly.
I thought it was great. Any questions? All right, Jen, thank you so much. That was terrific.
You're welcome. Thank you.
There's certainly a lot of information and much appreciated.
Yeah.
I hope we get to do this again. You let me know when you've got a next topic and we'll get this going again. And
all right.
Our next Lunch and Learn, I believe, is November 6th, featuring David Quick on cybersecurity. because as we've heard from David, nothing can bring your business to a screeching halt than some kind of security issue or breakdown. So have a good weekend, everyone, and thank you.
Thank you, you too.
Right.
Thank you.
Bye.